trust and your business. My name is Olivia Truzzo, and our goal for you today is to make sure that everything is transparent and simple concerning your 2016 income taxes. Our job at our firm is to ensure tax avoidance by minimizing your net income and maximizing your eligible deductions and tax credits. So if we jump right into it, essentially we've taken a snapshot of your current situation. This has helped us compute your 2016 income taxes. So we do acknowledge that you're married and you have 3 children. Unfortunately, your husband, Mr. Dalvi, did suffer a severe car accident a few years ago. Your eldest child, Mark, is now enrolled in university. Currently, you're working as a financial analyst and you're employed for a non-Canadian controlled company, and you and your family are recent homeowners. Our objective for today is to provide tax planning advice and to provide our recommendations. So today's overview is as follows. Number 1, we'll be discussing your minimum net income for tax purposes. Number 2, your minimum taxable income for tax purposes. And number 3, as previously mentioned, our recommendations to lower your tax burden. So, Mrs. Dalvi, first we'll be discussing subsection 5 of the Income Tax Act, which includes salary, wages, and bonus. So essentially, this section is quite simple. It's pretty much your employment income, so your salary and your bonus. So as discussed in your situation, your current salary is $143,000 for 2016. And for your bonus, we've only included a certain portion. So we did take into consideration that you did receive a total bonus of $34,500. However, for income tax purposes, we actually only include what you've gotten paid. So it's on a cash basis. So essentially our calculation below is as follows. We've pretty much taken 2/3 of $34,500 because you've only received 2/3 of the total amount, which gives us a total income inclusion of $23,000. So pretty much for subsection 5, we have your salary and bonus, and my colleague Anissa will go on to the other income inclusions.
Hello, Mrs. Dalvi. So now let's look at subsection 6, fringe benefits. So this applies when the employer pays an amount to or on behalf of the employee. The general provision suggests that all benefits are taxable unless they're legislatively excluded. So the items we've included are the automobile standby charge, subsection 6, 1E for an amount of $4,067, the operating cost benefit, subsection 6, 1K for a total amount of $2,034. Then there's the interest benefit, which is in subsection 6.9 for a total amount of $1,250, and the gift, subsection 6, for a total amount of $1,100. So now I'm going to go over how we came up to these amounts. So let's quickly look over the gifts. So you've received a $400 gift certificate, which is fully taxable because a gift certificate is considered mere cash. Then you've received an engraved wristwatch for a 10-year service, and this falls under long service award because it is a non-cash gift. You can receive this every 5 years, and the excess above 500 is taxable. So the value of your watch was 1,200, and the excess above 500 is 700. So we have the 700 plus the 400 gift certificate, which gives us the total of 1,100. We've excluded the $300 Christmas gift basket because it's a tax-free gift, because it's non-cash, it's not performance related, and the value is below 500. So now let's look at the calculations for the employer-provided automobile. So in your case, it's a leased vehicle provided by your employer, and the standby charge is calculated as follows. So since you've used your vehicle for 74% for business-related purposes, we will take your personal kilometers driven, so it's 15,000, divide that by 1,667 times the amount of months you've had the leased vehicle for. In your case, is 11 months. You would take that amount times 2/3 times the analyzed lease cost minus the analyzed insurance cost. In your case, since you had the vehicle for 11 months, it would be times 11. So that gives us a total amount of $4,067. So now let's look at the operating cost benefit. So again, since you've used your vehicle, the kilometers used for your vehicle was more than 50% for business-related purposes, so you have the choice between the lesser of 50% of the standby charge, which is $2,034, or your personal kilometers, which is 15,000 times 25 cents, which gives us 3,750. So you would take the lesser of these two, which in our case is $2,034. So now let's move on to your interest-free loan. So you received from your employer $250,000 as loan for your new residence, and you've received this on July 1st, 2016. And in order to calculate that, it would be as follows. You would have your loan of $250,000 times the 1% prescribed rate and times 1/2 because you've had the loan for 6 months. And this gives us an amount of $1,250. So all these items are included under subsection 6 as fringe benefits. Now let's look at subsection 7, which is the stock option benefit. So you've had the option to purchase shares, 1,200 shares at a trading price of $37, and you exercised this when the shares were trading at a price of $45. So in order to calculate that, you would subtract you would find the difference between the share prices times the amount of shares you bought, which is 1,200, which gives us a total amount of 9,600 to be included as your stock option benefit. And an important point over here is we would need to calculate this you need to calculate and include this at the exercise date, so in July 2016, because you're an employee of a non-CCTX. So your total inclusions from section 5, 6, and 7 is a total amount of $184,050.
Dalvi, my name is Hongwei. It's my pleasure to work with you. As my two colleagues have explained to you what will be added into your total inclusion, I am pleasure to have you indicate which will be deducted for your taxable income. Under the subsection A of the income tax, there are two parts will be qualified for deduction. The RPP contribution, 6,400, and professional association due, which is 1,200. Therefore, your total net income will be 176,450, which will be also your total taxable income, because there are nothing to deduct in the division C. There are also some omitted items, such as like the CBP, EI premium, contribution to United Way, medical fee, tuition fee, monthly transit passes, and disability benefits. These items will not be included in your net income or taxable income, but they will generate your personal tax credit. For meal and entertainment, you cannot claim the deduction since your employer already paid the some amount of your expense for meal and entertainment. Moreover, you are not a salesperson, so it's pretty difficult for you to claim a deduction in the subsection 8. And about the Christmas gift package, as my colleague Anista had explained to you, you cannot include it in the section 6. So next, we're gonna give you some recommendations for your tax income. Thank you.
Hello, Ms. Dalvi. I will be talking to you about the available tax credit, and also I'll be indicating the recommendation we've concluded for your case. First of all, let's take a quick look at the available tax credit that is really specific to you and your household. There's the infirm dependent over 17 years old tax credit. There is the eligible dependent tax credits, the public transit credits, the disability tax credit, and the tuition tax credit that needs to be transferred from your son Mark to you. Keep in mind that we have made our recommendations always in thinking of trying to lower the tax liability for your family household as a whole, not specifically for you or for your husband or your child. So this being said, any credits that are going to be available, that may be transferable from your husband to you or from any of your child to you, should be transferred in order to, as I've just said, lower the family household tax liability as a whole. This being said, we wanted to make some recommendation in order for you to contribute to a registered retirement savings plan to provide a further tax deduction. Keep in mind, Ms. Dalvi, your registered pension plan is administered by an employer, which is deducted at source for every paycheck. The registered retirement savings plan will be a supplementary source of income once retirement comes, and it can be converted to an annuity or a registered retirement income fund upon retirement. You can open up a registered disability savings plan for your younger married, and this, what is pretty neat about it, Ms. Dalvi, is that there is a grant that the government will add for every dollar you put into your registered disability savings plan. There are some limits and some restriction about it, but just keep in mind that there's a grant for the money you put yourself in the registered disability savings plan. And you can also try to think to open up a family registered education savings plan, and just as the RDSP, there is also a grant. Just keep in mind, you need, there's some limitations. That being said, we want to thank you for your business, and we sure hope to see you again next year.